If I had to start investing today from scratch, knowing what I know about where this market is, where fear keeps sneaking in, and where some of the strongest long-term stories are still hiding under that $50 line, I would do a lot of things differently. Most people think this game is about sounding smart, predicting the next pullback, or waiting for some perfect entry that never really shows up. But that's not how this works in a market like this. We're living through one of those stretches where the big indexes can look unstoppable while a pocket of smaller growth names still looks like it got left outside in the rain. And if you understand that disconnect, you can use it instead of being confused by it. It is Monday, April 20th in New York, so comment the day and date you're watching from. And quickly, if you value this kind of work, support the channel by subscribing and commenting John A.G. Best. That helps more than people realize. Now, I want to be clear right out of the gate. I'm not telling you to run out and buy anything blindly. In fact, one of the easiest ways to lose money is to hear a stock idea, get excited, and skip the part where your brain is supposed to clock in for work. If you're the one taking the risk, you need to be the one doing the digging. But based on recently published numbers, recent company updates, and the latest market action, I think there are 6 names under $50 that deserve serious attention now. Before we get to them, though, we have to talk about the mood, because the mood matters. The broad market has just pushed back to fresh highs, and that usually creates 2 bad reactions at the same time. One crowd says, well, I missed it, so now I'll wait forever. The other crowd says, everything must be expensive now, so there's nothing left to do. And both groups can be wrong. From recent market updates, the major indexes have been tagging records again, but under the hood, not every area has kept pace, not every former winner has recovered, and not every company tied to the biggest technology themes is trading anywhere close to its old peak. That's where this list comes from. Because here's the truth nobody likes to say out loud. Bears often sound brilliant in the short run. They always do. They show up with the dramatic music, the worried face, the giant red arrows, and the vibe of a man who discovered the moon is falling into the ocean. And every time the market wobbles, they take a little victory lap around the internet. But long-term wealth usually doesn't go to the people who sat frozen on the sidelines polishing their fear. It tends to go to the people who keep buying good businesses when the story is better than the stock chart. That doesn't mean every dip is a gift. Some dips are warnings. Some companies deserve to fall. But it does mean volatility is not the same thing as permanent damage. That's the filter for today. I'm not hunting for cheap-looking trash. I'm hunting for businesses where the long-term demand story looks alive, the company is still moving, and the stock price seems to be acting like the party already ended. Sometimes that gap closes slowly. Sometimes it snaps back all at once. Either way, that's where the upside hides. So let's start with Innodata. This one is not the loudest name in the room, and frankly, that's part of the appeal. Everybody loves to talk about the glamorous layer of artificial intelligence, the chatbot, the image tool, the cool demo, the shiny interface. Fine. But somebody still has to do the messy work underneath. Somebody has to help make the data usable, organized, labeled, checked, improved, and trusted enough for enterprise and model development work. That's where this company keeps showing up. And from its latest filings and company materials, it's talking about decades of data experience, relationships with several very large technology customers, and expanding work tied to model evaluations, agents, and even robotics. That is not the sexy end of AI. That is the plumbing. And the plumbing gets paid when the building keeps going up. What I like here is that this story doesn't require the whole world to suddenly fall in love with one consumer app. It's more business to business, more behind the curtain, more picks and shovels without using the cliche too hard. The stock had a huge run, then got chopped down hard, and now it's sitting in that awkward zone where momentum traders got bored, but the broader AI demand backdrop still looks real. And yes, let me give you the counterweight, because it matters. A stock that's already had a monster move can stay wild. Customer concentration is a real thing. Expectations can get ahead of themselves. But when a company is still guiding for strong growth and talking about broader customer diversification, that pullback starts looking less like a funeral and more like a reset. The second one is SentinelOne. Cybersecurity is one of those areas where people keep pretending it's optional right up until the building is on fire. Attackers are faster, more automated, more patient, and in plenty of cases they're not fighting fair, which, to be honest, is kind of their whole brand. So the old model of throwing alerts at tired humans and hoping for the best does not exactly fill me with confidence. SentinelOne's whole pitch is that security response has to get more autonomous, more connected, and a lot faster. Its Singularity platform and Purple AI push are clearly central to that story, and the company has been saying adoption of Purple AI moved past the halfway mark on new licenses in the latest quarter. That matters, because it suggests customers are not treating the AI layer like some little decorative add-on. They're buying it as part of the system. And that's why I think this is one of the cleaner disconnect stories on the board. The business appears to be improving in the ways you'd want to see: product depth, cross-sell, real platform use, continued innovation. The stock, meanwhile, still trades like investors aren't sure whether to clap or call security. That disconnect can last longer than people think, especially in software. But a quality name in a mission-critical category trading in the teens while the market keeps rewarding AI-linked infrastructure and enterprise efficiency stories? That gets my attention. The risk is simple. Cyber is crowded. Winning awards is nice, but it is not the same thing as owning the whole field. Still, recent product updates make it clear the company isn't standing still. Next up is NewScale. And this one is interesting because it sits right at the crossroads of two loud themes: electricity demand and AI infrastructure. We keep hearing about chips, models, inference, agents, cloud demand, all of that. Fine. None of it runs on fairy dust. It runs on power. And according to recent energy outlooks and federal updates, data center demand is becoming a major driver of electricity growth in the United States. That doesn't automatically mean every nuclear stock wins, but it absolutely means dependable power is moving back to the center of the conversation. NewScale's edge is that it's not just telling a dream story. It already has a regulatory head start in the United States, including approval around its uprated design, and that matters more than a lot of investors realize. In industries like this, paperwork is not paperwork. It's a moat wearing a necktie. Competitors can have beautiful slide decks, but if they don't have the same regulatory progress, it's not the same race. Now, let me also be fair. Small modular reactor investing is not for the faint of heart. This category has had delays, cancellations, cost arguments, and enough skepticism to fill a stadium. So no, I'm not pretending this thing is easy money. But when the market gives you a company with a real licensing lead, solid liquidity, and direct exposure to the rising need for always-on power, all while the stock sits in the low teens, I think you pay attention. If you're successful, share your success story in the comments so others can stay motivated. Now let's talk about D-Wave. Quantum is one of those words that can make people either wildly excited or instantly suspicious. And honestly, both reactions are understandable. There is a lot of hype in this space. A lot. Some of these names trade like the future arrived last Tuesday, so the skeptical case is not crazy. But D-Wave is interesting because it has spent years leaning into actual commercial use cases right now, instead of only selling a far-off dream. Routing, optimization, scheduling, logistics, things like that. Not everything in quantum has to begin with a science fiction voiceover. What changed recently is that the story widened. The company completed the quantum circuits deal, which gave it exposure to gate model technology alongside its annealing approach. That matters because one of the easiest attacks on D-Wave used to be that it was too narrow. That critique got weaker. On top of that, the company has announced a meaningful enterprise agreement with a Fortune 100 customer, and has talked about additional bookings after year-end, while also landing a university system sale. So now you've got a business that still carries plenty of risk, yes, but looks more commercially active than people gave it credit for. For me, that's why it stays on the list even after its rebound. It already bounced, but it still hasn't repaired all the damage from the old high. The fifth name is SoundHound AI. This is probably one of the more misunderstood stories in the group. A lot of people still hear voice AI and think of asking a smart speaker to play a song or set a timer for pasta. That's ancient history in this space. The real opportunity now is voice as a workflow layer for businesses. Restaurants, vehicles, contact centers, service desks, insurance, telecom, healthcare, retail, all the places where speaking is faster than typing and where companies would rather not hand every customer interaction to a giant platform owner. SoundHound has been leaning hard into that broader enterprise agent story, especially after Amelia, and recent releases show the company pushing voice commerce, contact center tools, insurance workflows, and wider enterprise automation. This is the one where scarcity matters. There just are not many public names that give you this kind of independent voice and conversational AI exposure at scale. And the business has been putting up real growth, with record annual revenue, a strong outlook for this year, and management talking about a record pace of enterprise deals. That doesn't mean the stock can't swing like a screen door in a storm. It absolutely can. But when a company is trying to become the agentic AI layer for industries that still run on clunky legacy systems, I don't think the market is done figuring out what that's worth. And then we get to my number one name in this group, IonQ. This is the biggest company on the list by market value, but it still squeaks under the price cap. And that makes it one of the most interesting setups of all. The bull case here is not just that quantum matters someday. It's that IonQ has already built real distribution, real cloud access, real government relevance, and a much broader platform story than a lot of people still realize. The company keeps emphasizing trapped ion performance, full stack ambitions, and expansion across computing, networking, security, and sensing. Its systems are available across the major cloud ecosystems, and the announced Skywater acquisition would pull more of the manufacturing stack into a trusted domestic pipeline. That is not a tiny detail. In strategic technologies, vertical integration can go from boring to beautiful in a heartbeat. Now, do I think quantum is going to be a straight line? Absolutely not. Anyone selling you that is trying to borrow your wallet. This sector is early, expensive, volatile, and full of companies chasing giant possibilities before the commercial picture is fully mature. But based on recently published numbers, IonQ already put up more than $100 million in annual revenue, and Wall Street is clearly treating it as one of the flagship names in the category. So if you want exposure to quantum and you don't just want a tiny moonshot with a pretty story, this is the one I keep coming back to. It's the most institutionally legible name in the basket, and yet it still trades in a range where retail investors can actually build a position without feeling like they're buying a luxury handbag. Now, before I wrap, I do want to touch the sponsored segment because there is a lesson inside it. Jet.ai is trying to position itself around one of the hardest bottlenecks in the AI infrastructure build-out, which is not just data centers in theory, but powered land, connectivity, and the early-stage development work that has to happen before the big money really shows up. The company says it has multiple active North American projects with combined capacity above a gigawatt, and its materials are very clear that it is trying to advance sites early rather than become a full builder and operator. That's the story, and it's a speculative one. But this is exactly where investors have to stay honest. A good theme does not erase hard risk. Jet.ai recently carried out a very large reverse split to stay listed, and its own filings lay out the obvious dangers: development delays, financing needs, permitting issues, thin trading, dilution risk, and the fact that current projects do not yet come with signed tenants. So while I understand why people get excited by the AI infrastructure angle, this is not remotely the same risk profile as the 6 names I just covered. It is much earlier, much thinner, and much more dependent on execution. In other words, the story may be interesting, but the speculator's helmet stays on. So there you have it. 6 stocks under 50 that I think are still worth real attention right now. Innodata, SentinelOne, NewScale, D-Wave, SoundHound, and IonQ. Which one would you buy first? And which one do you think is getting way too much hype? Drop it in the comments. And just remember, this whole market rewards people who can separate noise from signal. Not every falling stock is a bargain. Not every record high means the opportunity is gone. Sometimes the best setup is hiding in a name everybody stopped talking about for 3 months. This is for education and discussion only, not personal financial advice. I'm sharing how I'm thinking through the landscape, not handing you a shortcut around your own homework.